AM 580, always streaming inside your WDBO app. This is your chance to hop on the airwaves and just dive deep inside the experience of two certified financial planners with a certified financial group. Today we got Joe Bert and Chris Toadvine answering your questions today at 844-580-9326. Chris, Joe, how are we doing this day?
Good morning.
We're good, Joe.
Good
morning.
Yeah, good to be with you. As we say in the intro, Chris and I are here to answer questions. It might be on our listeners' minds, things you might be trying to figure out regarding your IRA, 401k, stocks, bonds, mutual funds, real estate, long-term health care, reverse mortgages, annuities, all the things that Chris and I try to sort out for our clients, getting them to and through their retirement years. As I say, Monday through Friday, Chris and I and 14 other certified financial planners provide retirement planning and wealth management for a fee, but on Saturday morning, we are here for you absolutely free. So if there's anything on your mind, things you've been thinking about, things you just maybe want to just clear up the mind fog, we are here. And the good news for you is the lines are absolutely wide open. And all you have to do is pick up the phones and dial these magic numbers.
844-580-9326, 844-580 WDBO. You're also more than welcome to send in an open mic using our free WDBO app. Just open up that app, find the open mic section down in the bottom right-hand corner, click record, send in about 10 to 15 seconds, and I'll push play on your question as if you're sitting in here studio with us. Chris, Joe, you want to hit the topic or you want to head into the open mics we received earlier?
Let's do the open mics. And let's tease the topic, and then we'll go ahead.
The topic today is FOMO. Of course, it's a fear of missing out, the cost of chasing headlines and hype, trying to buy that dip and all that stuff. It can be an interesting game over there. But again, the topic of today's show is FOMO, the cost of chasing headlines and hype. And if you've got a question, any question right now, again, Chris Toadvine and Joe Bert answering your calls live on the air, 844-580-WDBO, or you can send in your open mic using the free WDBO app like these listeners.
Hey guys, this is Mike from Orlando. I have about 40 or 50,000 I want to play with, trying to generate monthly income out of it. Any suggestions? Thank you.
Well, thanks for the open mic call there, Mike. And the question is, you have $40,000 to $50,000 you want to generate some income. So what's one of the first questions we'd ask Mike if he was sitting in the office, Chris?
Well, look, Joe, I mean, you know, the financial planning, which we do for our clients, we start by taking a step back and we look at the bigger picture. Like, you know, okay, well, what is your risk temperament? What other investments might you have? And how much income would you expect to get from this? You know, so can you generate income, Mike? I would say you can absolutely generate income. The question is going to be how much, you know, and how far down a particular path do you go to try to generate income? I read an interesting article this week, Joe. They talked about dividend investing, you know, and dividend investing seems to kind of go in and out of style, you know, with the larger economic trends and what have you.
Well, let's explain that.
Well, let's explain. So, you know, what is dividend investing? So, you know, investing 101, if you buy stocks, you're buying ownership in a company, and companies that are, you know, typically growing very fast, think NVIDIA, think SpaceX, maybe, Joe,
Mm-hmm.
and others of that ilk. When they're growing fast, they're reinvesting their earnings to try to continue growing. Amazon and Microsoft, all the Mag 7 and others, you know, and then there are other companies that are more mature. You know, think utilities. That's a great example of historically a dividend type stock.
Or AT&T or
AT&T, that's
General
right.
Motors.
Where the market is kind of mature, they have a harder time growing, and so they tend to share more of the profits with the stockholders, with the investors, and they do that in the form of a dividend. Mm-hmm. And so some investors will just buy companies that pay dividends. Now, and what I just said, Joe, dividend-paying companies oftentimes, not always, but oftentimes don't grow as fast. So the point being, if you give up on the growth companies and only focus on the dividend-paying companies, over time you tend to miss out on a decent amount of growth. So, you know, I think that's where getting clear up front on what is the bigger objective here. Is it just income? Or are you just trying to maximize income and not growth? Because, frankly, you could earn more in a money market from an income standpoint than you could the dividend on the S&P 500.
For sure.
Right? So if that's the goal, is just to get the most, we'll call it interest or income you can get, you can do that very safely in a government money market.
Right.
However, if you want some growth over time too, you got to sprinkle in other types of investments. And
One
Yes,
of
Joe.
the things I see every now and then is somebody's interested in a particular stock because it's paying a high dividend. Now, what that generally means is that the share price is depressed, but they're still paying out the dividend. So you're getting a lot of income for the amount that you invested. But there's an underlying story there: is why is the share price depressed? So you may be investing in that stock with the idea that I'm going to continue to get that high dividend for the amount of money that I'm investing. But what you may not know is really why is that share price depressed, and that's because institutional investors have looked under the hood and found some problems, and the share price is depressed. And so you may invest in that stock with the idea that you're going to continue to get that high dividend, but you may find that the company is dwindling before your very eyes.
That's right. So yeah, the dividend percentage. So some people will just shop investments
Right.
based on the dividend percentage. So let's do a little basic math here, Joe.
Let's do it.
If a company stock is $100 a share and they're paying out $5, what would that dividend rate be?
That sounds like 5%.
Sounds like 5%. Good job, Joe. You must have eaten your Wheaties
Let me
this
get
morning.
my calculator out to
Attaboy.
confirm that. Yep, that's
Yeah.
right. Okay.
Okay, so now, but if that stock price falls from $100 to $50 and they're still paying the same dividend, what would that dividend
That's
rate be?
10%, my friend.
Oh my goodness! Wow!
that.
Like, sign me up for that. I'm getting FOMO over here. So that's the idea. Okay, is if the stock price goes down, all things being equal, the dividend rate goes up, but that may not mean that that stock is something you want to own.
Right.
You know, the saying is, "Don't catch a falling knife." So this is where in investing you really want to understand, and we're big believers in diversification and not just buying one company for the dividend, but maybe exposure to an entire sector.
And the better thing is maybe perhaps buy a dividend-paying ETF.
Well, that's right. That's more tax efficient.
Right.
You know, Mike, it sounds like these funds you got are after tax, meaning they're not in an IRA or in a tax protected type account like that, IRA, Roth IRA, 401k. So in other words, you want the dividends, but you may not want to pay tax on capital gains if somebody in Idaho sells some of their shares to buy a new car, right? And that's what happens in traditional mutual funds. You have no control over other shareholders and what they do, and they're selling shares in the fund that you own can generate a tax bill for you. And this is why ETFs are just a superior investment vehicle. So, and you can get the same kind of investments in an ETF, but a lot of folks don't know that, and they're just more familiar with the old school mutual funds.
Right. And the beauty of that, though, is that you have the diversification as opposed to picking 1, 2, 3, or 4 or 5 different individual companies. You've got a whole basket full of companies.
Yeah, that's right.
And theoretically, you've got some due diligence being done by the fund manager, by the ETF manager to pick out those shares and make the decision when to get out of them.
Yeah, that's right. Or at least they have a screen if
Right.
it's tied to some kind of index. And there are a number of ETFs out there, Mike, that are dividend oriented. You know, from all the major players out there, both more, I'll say, passive in terms of their structure, tracking an index, or more active, where you have a fund manager who's actually trying to deselect the losers and maybe overweight the winners, type thing. So there's lots of choices out there, but I think you got to go back to the drawing board and say, okay, what is the bigger goal? Because again, you may find an ETF with a dividend rate of 3 or 4%. I would say be cautious, Joe, right? Because sometimes when you see funds that have a very high dividend rate, they may be using leverage within the fund.
Oh, yeah.
What do I mean? Well, they're borrowing, internally to generate a higher level of income. And that works well until something happens, and then, sometimes it can whipsaw. So I would just say, as always, caveat emptor, right? Let the buyer beware of what you're investing in. But again, you can do pretty well sitting in cash today, but when you look at inflation over time, cash is not going to grow. And so, I would advocate for, at least considering exposure to things that are going to grow, and how much of those things and how you try to maximize your income, I think, is a more specific question, Mike, that's tough to answer, generically.
Well, we talked about generating income from equities. You can also generate income from fixed income investments.
You can indeed.
So
Joe.
give me
That's
some
good-
examples
Good
here, my
point.
friend.
Well, look, bonds. What fixed income? What is fixed income?
The other side.
It's a bond, and so a bond is a loan you make to a government, to a corporation, to a municipality, and so there are different types of bonds. And typically, what you do is you say, okay, I'm going to loan you $1,000. They say we're going to pay you 4% for 5 years, and then at the end of 5 years, you get your $1,000 back. And you hope it plays out that way. And typically, with high quality bonds, that's how it works. So, that's a safer way to invest. The risk spectrum there is, the lowest rates are generally government or municipal bonds because there's some tax advantages. And then, U.S. government, shorter term, and then longer term have higher rates, and then corporate bonds, and then high yield bonds. Joe, what are high yield bonds?
High yield bonds are bonds issued by companies that whose financial future might be in question.
Lower credit quality, they say, right? So, and those pay the highest rate of bonds, but again, they tend to behave like stocks if things go south
Another
or
name-
when things go
Another
south.
name for those is junk bonds, maybe.
Junk bonds, that's right. Michael Milken.
Right.
So, but so you just have to be aware of that because you can put your $50,000 in a junk bond fund and generate 5 or 6% and be feeling pretty good about that today. But if that 50,000 goes to 35 when the market goes south, that doesn't feel so good, and that may not be what you signed up for. So, you just have to know, as with all things in life, there's a trade-off. And in investing, that trade-off is risk versus return. And if you're willing to embrace some risk and live with the volatility, you can generate normally more income or higher returns over time. But that doesn't mean every day, month, or year will you win with higher returns.
Yep. Every investment has a trade-off. You need to understand what it is you're after, what your time horizon is, and how much risk you're willing to take to get that return, and how it fits into your overall portfolio.
That's right. That's right. Mike, we appreciate the question. Thanks so much. Hopefully we helped you at least a little bit with some principles to follow there.
All right, Josh, take it away.
Thank you so much, Chris. And Joe, if you want to call in, I open lines for you, 844-580-9326, 844-580-WDBO. Also more than welcome to send in your open mic using that free WDBO app. You're listening to On the Money, where we're planning tomorrow
Today.
with the Certified Financial Group.
CNBC of nearly 40,000. And because they won't divulge the selection criteria, asked my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent.
But we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy, your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers.
Welcome back to On the Money here on WDBO, brought to you by the Certified Financial Group. On the airwaves today, we got Chris Toadvine and Joe Bert, two certified financial planners with the Certified Financial Group. My name is Josh McCarthy, the middleman between your questions and the answers provided by the Certified Financial Group. If you want to call in, we got some open lines available to you, 844-580-9326, 844-580 WDBO. You are also more than welcome to open up your WDBO app, navigate to the open mic section, and send in your question that way. Just give us about 10 to 15 seconds of your question, and then we'll pass you along to the experts with the Certified Financial Group, like this listener.
Good morning. I have a question for you. I just sold my home and have about $370 in the bank from the home purchase. I'm looking to buy a home underneath that. Do I want to take out a mortgage and use the differential in cash in some type of investment, or just pay cash for the home with the interest rates at where they're at?
That is a great, great question. So here's a gentleman that sold his house, has cash. Should he buy a new house and finance it to some degree, or should he take the funds and invest it in some way, shape, or form? This is really a financial planning 101 question.
Yeah, it is, Joe. It really is.
So what would you do here, Chris?
Well, what would I do? I mean, look, again, Yeah, I'd love to know a little bit more about his situation, but I think big picture, what would I do? I mean, interest rates today, if he's getting a new mortgage today, you're probably looking at 6.5, plus or minus a little bit, depending on the day you do it. So that's, that's a much higher hurdle than the 2.5, 3.5% of old that so many home buyers grew accustomed to.
But let's peel the onion back a little bit. So here's a gentleman that has cash. First thing we would do for financial planning, I know you would do, and I do, and all of our planners do the same thing, is let's look at the big picture. First of all, how old are you? Secondly, what's your need for liquidity? Thirdly, what's your overall investment situation? Could that money be invested perhaps in a retirement account? Could you stuff some money in there? Are you self-employed? Is there some opportunity in that regard? So there's a lot of different variables that you want to consider. It's not just, I have some cash, what should I do with it?
Yeah, that's right. Well, and what is your income and your capacity to pay the mortgage? If you don't, let's say, buy the mortgage down by putting a bigger down payment, from the cash that you have, and you were to take that and invest it in hopes of doing better than the rate you're earning on your mortgage over time, which, presumably you could over time if you had some risk temperament there. But at the same time, you have to make that mortgage payment. So you have to have the cash flow. And these are the kind of things that I would be asking if we were sitting down with this gentleman. So, and not knowing that, it's tough to say exactly what I would do. But, look, if you could, and, like you alluded to, Joe, do you have an emergency fund? That's where it starts right there. Okay. Do you have some other cash on hand that you can use if the washer breaks down or the tire goes flat or whatever it is? Life happens, and so do you have adequate amount of cash? Because if you don't, what I would want to do is set aside some portion of this as an emergency fund.
Right.
And then we look at do you have other debts? Do you have credit cards? Do you have, car loan, all that kind of stuff, and really work backwards. So, but what I would say, go ahead, Joe.
But this is what the modeling with our software would allow us to do, to plug in all the various scenarios that you could have. Let's look at, if you do this, this is what happens. If you do that, that's what happens. You take out the mortgage for 15 years, this is what happens. You do 30 years, this is what happens. You take this money, put it in a retirement account, this is what happens. And that's the beauty of the technology that we have at our fingertips today, to be able to model all these different scenarios so you don't make the decisions on the back of an envelope.
Well, that's right. So you can understand the longer term implications and what's going to generate the best financial result over time. Right. But part of the things that we can't know from the open mic, Joe, is, okay, how do you feel about investing in the markets and having debt? And, sometimes it makes a lot of economic sense to have a mortgage and to keep that. But, I have had clients, Joe, that it caused them anxiety, agita, right?
Exactly.
And they didn't like it. And I say, well, look, pay it off then, okay? Because, optimizing financially is not always the most important thing.
At the end of the day, you want to sleep at night.
You got to sleep at night. So I'm hearing some bumper music, Josh. Why don't you take it away and we can pick it up on the other side of the break, Joe?
You got it. You drop it, I'll pick it up, and then we'll all keep on going on together. You're listening to On the Money. Of course, if you've got a question for the Certified Financial Group, I invite you to call in 844-580-9326, 844-580 WDBO. Send in your open mic as well. You're listening to On the Money, where we're planning tomorrow today with the Certified Financial Group.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 CFG has been chosen once again as one of the top 100 financial advisory firms by CNBC of nearly 40,000. And because they won't divulge the selection criteria, asked my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent, but we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, "Hey Lou, I need to, I'm barbecuing this weekend, right? What do you like?" And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot.
On the money. Central Florida's most listened to financial call-in show. Brought to you. It's the only show hosted exclusively Monday through Friday. They're CFP. But on Saturdays,
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. This is your chance to hop on the air. Get your questions answered. Financial planners with a certified financial group. We got Joe Bert and Chris Toadvine on the mics today. My name is Josh McCarthy, answering your questions with WDBO. If you want to call in, go ahead and call in 844-580-9326. That's 844-580-WDBO. If your question is a little more of the sensitive nature and you want to call right off the air to the walls of Certified Financial Group, Charles Curry is taking your calls right now at 407-869-9800. Again, Certified Financial Planner Charles Curry available to you right now off the air at 407-869-9800. Chris Toad.
There we go. Come on, Josh. Third time's the charm, my friend.
Chris Toadvine and Joe Bert, take it away.
Let's do it. Joe, what do you say?
Let's do it.
Yeah, talk about FOMO.
Our top, that was the topic we opened the hour with, and we never got to it because of the open mic calls. Yeah, let's talk about FOMO. Stands for
fear of missing out.
That's
fear
right.
of missing out. Another acronym, Joe.
The train's leaving the station, and I'm not on it.
That's, oh my goodness. And you better run. You better run. You got to catch it.
Because everybody else is on it. And
everybody's doing
on
it, Joe. It must be the thing to do if everybody's doing it. So that's
it's a natural inclination. It's our brain once again, the emotion taking over.
That's right. And that is the key, Joe. Is it's emotional and not necessarily rational.
Yep.
And oftentimes when we make quick emotional decisions, they don't turn out to be the best decisions.
It's true in money and in love.
And money, hey, there you go. Who knew we were going to get a little relational advice on here with the Oracle? Do tell, Joe. So nonetheless, yeah, FOMO, and that's it's something that it's always there, and SpaceX I think is the most recent example. And I think that's what brought this to mind for us, Joe, because there was so much hype around SpaceX.
Yep.
And there are those that just want in; they just don't want to miss out. And like you say, it's a human condition, and I understand it. And yet, when you look at the history of IPOs, a lot of times, particularly with something that's highly publicized and talked about all over social media, that's not the best time to buy. So what happened with SpaceX, Joe?
Well, it opened at 150,
I think.
150, 152, and it closed yesterday at 140.
Closed at 140,
So
but
it's a roller coaster.
Give us a little more color there. So yeah, that roller coaster had a climb initially, right?
Right.
So it went from 150 to 2.25, right? 225. So had you sold there, you'd have been pretty happy.
Right.
I mean, that's a good 50% return.
Not bad.
Not too bad. But if you bought there because, oh my goodness, everybody's doing it and look at what it's doing and it's living up to the hype and I got to get in, it's 224. I don't want, And then what happened, Joe?
Well, the bottom fell out.
The bottom fell out. So, and it's what causes the bottom to fall out? Normally, at that point, somebody starts asking questions. Maybe there are some folks that have shares that are unloading saying, yeah, I've made my money, I'm out. And that causes the price to fall. But I think oftentimes you get a few weeks into these things. It was like Coinbase. I don't know if you remember Coinbase.
Mm-hmm.
I had a few clients that they wanted to own Coinbase, and same thing. It came out hot, crypto exchange and what have you. But then at some point, reality sets in a few weeks later, and life goes on, and there are other headlines to be interested in. And questions start being asked. Hey, what would it take for SpaceX in the way of earnings to justify this stock price? And then, those questions become headlines, and then people start selling and go, geez, I don't want to be the last one standing when the music stops here. So they jump out, and it went all the way down to 104. So started at 150, went to 225, down to 104. So if you had bought at the high,
you couldn't wait to get in. The train's leaving the station. Here's an opportunity. My broker just called. I can get it today at 250. I'm in.
2.25. Yeah, that's right. I'm in.
Yeah.
And then you proceed to lose 50+%. And so, and again, now it's back to 140 as of yesterday's close. But I think there have been a number of examples of this, Joe, historically. Can you think of others?
Off the top of my head, I'm sure.
.com.
Well, they're all.
I mean, that's a big one, right?
Yeah, those are all.
I mean, if it says .com, it's going to be a winner.
Yeah.
Got to win.
Yeah.
right?
What was the one? The
GameStop.
Yep.
Yeah, the meme stocks they called it, where early people got in and bid up these prices of low price stocks, and then, oh my gosh, look at what it's doing, look at what it's doing, you better get some. And then those early participants jumped out in many cases, and the bottom fell out. What about the housing bubble, Joe?
Oh yeah.
I mean, that's, you better get a house now,
right?
Buy now or you won't be able to, and then you get all that demand, and that was a systemic thing, right? I mean, that caused the Great Recession, really.
2008, 2009.
That was.
And on the other side, then you've got the other side where the world is coming to an end. I need to get out.
That's right.
And
it's FOMO in the other direction.
Yes.
So
it's the emotion. It's all the emotion. This is what we do as certified financial planners: is try to wring the emotion out of these decisions and look at it from a purely straightforward, objective standpoint to try to sort the thing out. And if it fits in your overall, but we're not individual stock pickers. During this SpaceX run up, I know you've had calls, I had calls of people that don't invest in individual stocks. We don't do that for our clients, but they wanted to get on the SpaceX. This is the opportunity to really have a lifetime. Elon Musk, we need to get some of that. And the caution was, first of all, you couldn't get unless you're an institutional investor.
That's
you have to wait till it ultimately went public, and then you can get in at $225 a share. Only 10 up getting burned, and we didn't make their recommendation for that reason. And now thinking about SpaceX and Tesla and all the wonderful things that Elon Musk is doing, these companies, unfortunately, for the most part, aren't making any money.
Yes.
And I was thinking about that on the way in this morning. He is the driver behind all those companies.
He is, yes. A lot of risk there. One guy
exactly.
is the engine behind it.
Exactly. That's my point.
Yes.
I mean, what if that? He's not a spring chicken either, and he's under a lot of pressure. He doesn't wake up one morning.
Yeah.
What happens to the value of all those stocks? What do you think?
Well, look, I think initially the stock would fall like a rock.
Yeah.
I mean, that's what I think would happen. But
and then
you hope that he has shared his vision with enough people that it could carry forward. But no one is Elon, and I think he is a unique individual in the grand scheme of history, and what he's doing is remarkable. And I hope he does continue to wake up, because I think he's doing lots of neat things,
I agree.
He thinks on a different plane than most of us.
I have a Starlink satellite.
Do you?
Yes, yeah, that's how we get our internet.
Oh.
Yeah.
You like it?
Yeah, it works very, very well. I mean, he's onto something there. I mean, it works great, and it's all over the world. And
well, the thing of it is, he's been onto it for a long time.
Yeah.
I mean, so he was just years ahead of the rest of us.
Yeah. And when you stop to think about it, he is in fact the most powerful man in the world. Not only financially, but his ability to control the satellites.
Yeah.
Because the satellites is, the communications and what you can do if you don't have those communications. And that is really, he is a
very powerful guy.
Very, very powerful guy.
For sure.
Yeah. And he's probably, I'm sure he's a target.
Thank God he's on our team. Yeah, he has security. Yeah, I know he has a lot of security around him at all times.
But
would need it.
But you're betting a future on one guy that if that happens, heaven forbid, what's the value of the investments that you've made there? So you want to be careful if you got any investments tied
on that one. But I think the bigger idea, Joe, is FOMO.
Yep.
And that oftentimes emotional decision. And I will tell clients who are sort of inclined towards rolling the dice occasionally, have a casino account.
Yep, I agree.
And that's what we call it, a casino account. And you know what? So what do you do if that's you? And so we all got to look in the mirror occasionally and do a little self-reflection, be honest with ourselves. So if that's me and I'm prone towards an itchy trigger finger when these quote unquote once in a lifetime opportunities come by, what can you do? Well, I think you can have a separate casino account that's walled off from your serious investments. Yep. Some people will call it core and satellite, but however you want to refer to it, but have that account out there, put a fixed amount of money in it. And you know what? If you want to buy SpaceX, you got to sell one of your other investments, or you're limited in terms of how much you can buy. And like I say, I have clients that do that, and that's sort of how they sometimes will entertain themselves. And
it gives them bragging rights at the cocktail parties.
If they win.
Well, of course.
Yeah, that's right. That's right.
Yeah,
well,
but once again, it's all emotion.
It's all emotion. And that could lead to a whole different conversation about the markets. And, it's very difficult to do better than the markets over time, consistently. You might have one or two high flyers, but it's very difficult over time. But, Joe, as I was thinking about this, FOMO, it's a new term, right? Relatively. I probably learned it from my kids. Because they experience it too.
Oh, yeah.
Not with investing. So it's, that's where it's part of the human condition. And yet, it goes back to, remember the tulip bulbs in the 1600s?
Oh, yeah.
That, it was like a sign of prestige to own unique tulips, and the prices got bid up, and then all of a sudden there was no interest, and the prices crashed, and people lost a bunch of money, and so
How about Beanie Babies? Remember Beanie Babies?
Yeah, pet rocks. Oh, yeah. There you go.
Yeah,
So
there'll always be another glittery thing out there, another shiny something that I want to separate you from your money. So you got to be
that's
very,
right.
very careful.
And so with investing, it's better to have ice water running through your veins, or as Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. Right. Yeah. So that sums it up pretty well in a sentence. It's not always easy to do, because we can all get sucked into these kind of things, and we're only human. But at the end of the day, I think you have to have guardrails for yourself to protect, particularly your serious money. When it comes to investing, you've got to have guardrails and really a sounding board, Joe. And I think that's the role, one of the many roles that we play for clients, is to be a sounding board and to just have a conversation about things like this before, that itchy trigger finger, ready, fire, aim.
I think it's more critical than just the number sometimes. Just keeping you from perhaps doing something ill-advised and making a decision purely on the emotion or what your brother-in-law might have said or what you might have read. There's something to the other side of the story. And then you have to be careful about what's on the internet today. All this hype about whatever's out there. And yeah, it's an interesting time in which we live, but there are opportunities, and that's what our job is as certified financial planners, is to sort through all that stuff, see how it fits in your overall scheme of things, what it is you're trying to accomplish, what your plan is, and try to stick to the plan, because the winds blow, things change, times change, but your plan is your plan, and you want to stick to it based on what you originally set up.
Sort of like the Constitution, Joe.
Yeah.
Right? I mean, that you identify up front what's important and what we're going to do and how we're going to, make decisions. And, there are occasionally amendments to the Constitution. Your plans change.
That's true.
Like life happens.
That's true.
But
you don't want to amend your plans based on what's going on in the economy.
Well, that's right. No, exactly. Because, like I continue to share with clients, like we've been in a very good season from an investment standpoint. But we know that won't go on forever. And when you have a season of above average returns, it's likely you're going to have some time with below average, because you're going to get to the average over time. And so, I think it's also, trying to adjust the sails in light of that, and, be mindful of these bigger things that happen, but not reactive.
Exactly. So, all right, Josh, I hear the bumper music. Take it away, my friend.
If you want to call in, open lines for you, 844-580-9326. Send in your open mic using the free WDBO app. Charles Curry taking calls off the air, 407-869-9800. One more segment with Joe Bert and Chris Toadvine. You're listening to On the Money, where we're planning today with the Certified Financial Group.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40. CFG has been chosen once again as one of the top 100 financial advisory firms by CNBC out of nearly 40,000. And because they won't divulge the selection criteria, ask my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent.
But we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, "Hey Lou, I need to, I'm barbecuing this weekend, right? What do you like?" And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart.
Perfect. Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. My name is Josh McCarthy, sitting here on the radio with Joe Bert and Chris Toadvine, two certified financial planners with the Certified Financial Group. We also have Charles Curry taking your calls off the air as this episode comes to a close. He's available to you, Lou, live at 407-869-9800. Chris, Joe, what do you say we bring it home with a text question?
Let's do it, Josh.
All right. We got Lila who writes in. Lila says, my advisor has offered me a private investment, and I am wondering what you think about these and if it makes sense for someone nearing retirement and looking for income.
Well, let's define private investment.
What is a private investment? Well, generally speaking, Joe, a private investment is not a public investment.
Yeah, makes sense
so
to me.
in other words, it's not something that you can go out to the public market and buy, or really through a brokerage account to Charles Schwab, Fidelity, whomever, like a Coca-Cola or a Costco or a Walmart or something like that, where it would be publicly traded.
Easily bought and sold.
Easily bought and sold. With a push of a button, you can get in or you can get out. So
Right.
private investments, Joe, how do they work? A lot of paperwork for starters, right?
Right. And generally, you have to have what's called a private placement memorandum, with a lot of fine print in it. And you have investor suitability. And the reason you have investor suitability is because the government says if you can afford to lose your money, we've told you all the risks that are involved in all the pages of this thing. So generally, you have to have a net worth exclusive of your home of $1 million or more, or have income of $250,000 a year. So the government says if you've got that kind of income or net worth, you can afford to lose your money.
There you go.
So that being said,
That being said, so then if you still want to move forward after you read the 40 pages of risks, then you will invest in this private investment. They have different objectives. You know, some might be in stocks, some might be in bond type private equity, private credit, real estate. There are lots of different things. So Lila, the first thing I would do would be to understand, what does this one invest in? Who is the company associated with it? And do they have a track record? And and then always, Joe, I think diversification is key, and you don't want to overload the boat because, I'll say these types of investments are relatively easy to get into. There's some paperwork, and you can't push a button and get into it, but getting out can be much more difficult.
right.
And that's where folks, in the recent past, there were some questions around private credit. So in other words, companies that are raising money, not by selling bonds publicly, but privately, and investors wanted out, and more investors wanted out than they had funds to let out. And so guess what? You're not getting out, or you're not getting all your money out. So, I think that private investments are not for everyone. And I think it's important to understand, what are you investing in? Who are you investing with? And be sure that it is appropriate for you once you understand it. And a second opinion is probably in order, Joe, wouldn't you think?
Without question. And probably definitely no more than 5% of your net worth. I mean, you got to remember that this is risk money. The reason that you're getting the higher than expected return is because there's risks involved
right.
in that private placement memorandum. So I hear the bumper music, Josh. It's been a great program here with my friend Chris Toadvine.
Yeah.
Thank you so much, Joe and Chris. You've just listened to On the Money, where we're planning tomorrow
Today.
with the Certified Financial Group.